Good evening. Thanks for joining us. This is NTD Business, and I'm Paul Graney. Big Bitcoin news. Tesla invests big in the cryptocurrency, and boy did it rally. Janet Yellen thinks Biden's massive stimulus plan will end unemployment. Lance Roberts thinks differently. And what are the knock-on effects of cancelling student debt? One economist warns of some unintended consequences. Tesla is buying Bitcoin and says it will even start accepting it as payment for its cars soon. As you'd imagine, Bitcoin surged over 14% today on the news. We don't know when or at what price Elon Musk bought it at, but he has been pumping it all year. What we do know is that Tesla spent $1.5 billion on the coins. It had over $19 billion in cash at the end of 2020. Musk says his board is also letting him buy gold, but I don't think he bought any. Fred Katamai reports.
Bitcoin got a jolt of confidence from Tesla. The electric car maker said it invested $1.5 billion in the electronic currency, driving it up more than 15% to a record high. Analysts say the company's investment could prove to be a game changer for Bitcoin. While central banks have been skeptical of digital currencies, some big financial institutions like BlackRock and PayPal support them.
This is a game changer move for Tesla in terms of Bitcoin. It really validates some of the strategy that we're seeing for some corporations, MicroStrategy, now Tesla. The fact that Musk went into the deep end of the pool on Bitcoin, it's going to send a ripple effect really across the board.
Tesla also said it expects its customers will be able to use Bitcoin to buy its cars and other products in the near future.
I think it's something that could really start to change from a commerce perspective how we use Bitcoin.
Bitcoin, which has set new record highs in recent months, has had a roller coaster ride over the past decade. But Tesla CEO Elon Musk has endorsed Bitcoin and other cryptocurrencies in the past. Just last week, he said Bitcoin was on the verge of being more widely accepted among investors. In December, he asked if it was possible to do large transactions with it.
And Wall Street reached all-time closing highs on Monday. S&P 500, the Dow, both in their longest winning streak since August. The Dow rose nearly 238 points, or 0.76%. S&P 500 gained nearly 29 points, or 0.74%. The Nasdaq added over 131 points, or 0.95%. Look at those bulls go. Oil prices rose to their highest in over a year. Supply cuts, hopes for demand, helped energy stocks jump 4.2%. Fourth quarter reporting season is now more than halfway through, with nearly 300 companies having reported results. Analysts are now seeing S&P 500 earnings posting a year-on-year gain of 2.4%. Who would have imagined? Much better than an earlier expectation of a 10% decline. Got that right. And the new Treasury Secretary Janet Yellen says we will see full employment by 2022 if only we pass Joe Biden's $2 trillion spending bill. Stock markets will be even happier. Yellen says without the spending, we might not recover for another 4 years. Here's the details.
Janet Yellen told CNN the U.S. could reach full employment next year if Congress passes Biden's stimulus plan.
I would expect that if this package is passed, that we would get back to full employment next year.
Generally, an unemployment rate of 4 to 5% is considered full employment. Right now, we're at 6.3%. Yellen also said if the federal government doesn't give more support, it would take until 2025 to get the unemployment rate down to 4%. Obama's former economic advisor, Lawrence Summers, warns that it's also necessary to consider what level of stimulus is appropriate, so it doesn't set off inflationary pressures. In an op-ed in the Washington Post, Summers said that the lessons from the 2008 financial crisis suggest that it is appropriate this time to err on the side of doing too much. However, he said careful analyses of risk scenarios should be carried out, and that ignoring the threat of inflation can be dangerous. Yellen did say she's considered the risk of inflation, but there are tools to deal with that, and right now the economic suffering is a bigger risk.
We may be seeing those inflation fears play out in the market today. 30-year Treasury yields broke 2% for the first time in about a year. Gold and silver super hot today as well. But can Yellen and a massive stimulus plan really fix unemployment? Massive parts of the economy are completely transformed. Look at travel, dining. Can stimulus checks really fix that? Lance Roberts at Real Investment Advice says it's like putting a Band-Aid over a gushing wound. Ouch. Asked about Yellen's big full employment plans.
As we look really at what employment is, she talks about full employment. Well, historically, 5% has been what we could determine full employment in the economy. And to explain what that means real quick is that means that out of the labor force, those counted as part of the labor force, 95% of the people are working. Sounds pretty good. The problem is that the labor force participation rate continues to step down, which means we have more and more individuals sitting outside the labor force. They're no longer counted for it. So we could actually get to full employment, but actually have more people in the economy unemployed than before because of the way that we calculate unemployment. So when she talks about getting back to full employment, we could basically eliminate everybody out of the labor force and have full employment. So that's what that means.
And are we seeing this particular type of shift out of it? In what particular areas? What's now classified that wasn't classified before?
Well, and that's the thing is when you're out of work for a period of time, and again, in March of 2020, we shut down the economy, so a lot of people were laid off. And we're still clipping off over 1 million claims a week. And, previous any recessionary peak in history, jobless claims peaked out at about 687,000. That was the max at any recessionary peak. And we're well past the peak of the recession now. We're almost back to economic growth, right, according to the government. But we're still rolling off 1 million people a week. Well, once you're out of the labor force for a period of time, the government no longer counts you. They just assume you don't want to work anymore. So that labor force participation rate used to be in the 70s. Then it went into, it was 63, 64% under the Obama administration after the financial crisis. Now, after the COVID crisis, we're down closer to 60% participation. So the number of people participating in the economy keeps getting less and less. And, the important thing here, and this is the key thing, if I inject liquidity into the economy through a stimulus check, and I'm a business owner, yes, I'm going to have some short-term demand because you've got stimulus in your hand. You want to come spend it with my business. So I sell widgets and you come buy my widget. But I know as a business owner that payment is temporary and it goes away. So I'm not going to go out and hire a bunch of people to come to work for me because they're expensive. Labor cost and benefits and healthcare. And those are permanent. Once I hire somebody, I'm stuck with them. And under the PPP program, I can't fire them. So the problem is businesses aren't going to rush out and hire a lot of people. And this is why we continue to see these temporary layoffs becoming more and more permanent over time. And that's why stimulus doesn't create economic growth, because we need people producing, but businesses won't hire based on stimulus. They need certainty about future economic growth and consumption.
And so what fundamentally do we need to address this unemployment problem? It's fundamentally growth, right? But specific type.
Well, it's not. It's what you need to create economic growth is that you need to create the environment, not stimulus. You need to create an environment where businesses have certainty that they can go out and invest capital and get a rate of return on that capital. And when they can do that, then they'll start putting more capital to work. This is what we call capital expenditures. The problem is we have, by pushing interest rates to zero, interest rates are now at a level that it doesn't foster economic prosperity. So when you have an extremely low rate environment, and this is what's happening in Europe in particular, there's no incentive to go spend money into an economy where I'm only going to generate a 2 or 3% rate of return when I can invest it into the financial markets, as an example, as we see through a lot of the banks, and invest the capital that way where it's more risk-free. I can invest it in the stocks and bonds, make a bigger return than I can loaning money to individuals to go start a business. But without that, what we call monetary velocity, where money flows into the economy and creates jobs, until you create the environment to make that happen, you're not going to get economic growth. And that's the thing that really the administration needs to focus on, is creating the economic environment, creating the environment to entice businesses to go out and spend money and create jobs.
And Yellen might want to have a word with Joe Biden about his minimum wage plans. The Congressional Budget Office says raising it to $15 an hour by 2025 would cost 1.4 million jobs that year. Businesses will often just automate jobs or lay people off if they can't afford the new minimum. Profit margins at a lot of businesses aren't always that wide. The CBO did say, though, that the plan will lift 900,000 Americans out of poverty in 5 years. But the raise will also reportedly increase the U.S. budget deficit by $54 billion over the next decade. President Biden has backed away from including a $15 minimum wage in the relief package. That's after key lawmakers signaled they no longer support it. And another campaign promise is canceling student loan debt. Biden promised to cut $10,000 per person, but now progressive Democrats want him to cancel up to $50,000. Sounds nice, but who's going to pay? NTD's Patrick Hayden takes a look.
Raising tens of thousands of dollars in student loans might sound nice to people struggling to pay off their debt, but what's the future impact? Economics professor Anthony Davies said it would create a class of people who are dependent on the government.
This is going to come about because, quite reasonably, next year's graduates are going to say, well, the previous year's graduates' loans were forgiven. Why shouldn't mine be?
Davies says it isn't fair to people who have worked hard to pay off their student loans. And if the debt is forgiven, he believes colleges and universities will just increase their tuition even more.
This is my prediction. If indeed we get to a point that the federal government is going to forgive, let's say, $10,000 per student of student loans, very quickly you're going to see tuition and fees rise by about that same $10,000.
He says some degrees make way more money than others, and taxpayers shouldn't have to pay a student following a dream that doesn't match up to market value.
For example, at the high end, a student with a 4-year degree in petroleum engineering can expect to earn over the course of his or her career around $7 million. That's plenty enough to pay back a student loan. On the low end of the scale, you have majors in early childhood development that actually pay less than a high school diploma.
He says currently universities don't have a strong incentive to make sure students can repay their loans. And one way to fix this is to make them fund student loans directly out of their endowments.
If you did that, it would overnight make colleges and universities laser focused on making sure that their graduates were able to repay their student loans, because the colleges and universities would directly be on the hook for the money.
He says even small colleges have large enough endowments to underwrite student lending. But if they go forward with student loan forgiveness, the big losers will be future students and taxpayers. Patrick Hayden, NTD News.
When the pandemic first hit, many Americans started using buy now, pay later services. In fact, it's even more popular now. But are we biting off more than we can chew? NTD's Patrick Hayden reports.
Buy now, pay later services have blossomed since early last year when the pandemic hit, but it's making some regulators worry that consumers are spending more than they can afford. A Credit Karma study found that nearly 40% of US consumers who use buy now, pay later have missed more than one payment, and 72% of those saw their credit score decline. One Credit Karma leader said the percentage of people missing payment is remarkably high. He said, when you make something so convenient, people may not be really thinking, do I have the budget? Can I afford this payment? You get more of that impulse shopping behavior that leads to realizing they may not be able to make the payment. The study surveyed over 1,000 Americans to gauge interest in buy now, pay later services. It found that 42% had used the service before. It's unclear how buy now, pay later fits into US regulations because the companies that offer these services don't have bank charters, and some don't even charge interest. Some experts think the sector will come under more scrutiny during the Biden administration. Patrick Hayden, NTD News.
Well, some incredible figures there. Scary. And New York Governor Andrew Cuomo is letting restaurants reopen for partial indoor dining a few days earlier than he planned. Thanks, Governor. He says he's doing it because restaurants need more time to prepare.
They have made the point that they'd like to open a couple of days earlier so they can be ready for Valentine's Day, get the staff oriented, get supplies into the restaurants. And that's a reasonable request. So we'll start indoor dining on Friday at 25%.
Thousands of New York City restaurants that have survived the shutdowns are relying on takeout and makeshift outdoor dining. This is the second time they are reopening for partial indoor dining since the pandemic started. And Cuomo says the statewide infection rate has steadily lowered to 4.42% on Sunday from about 7.9% in early January. That's still to come this evening. 2 South Korean car makers refuting claims they're working with Apple on electric cars. So who will make Apple's new self-driving car then? The list is getting shorter. And China's central bank teams up with the world's top interbank messaging system. Does that mean China's digital currency is one step closer to going global? Find out more when we return.
Trends may be fleeting, but values are timeless. We now bring you this new clothing brand with classic design and luxurious comfort. It's our way of sharing hope and inspiration from the world of Shenyun. We bring you Shenyun Dancer. Wear it with honor.
SoftBank's profit for the last quarter jumped more than 20 times. As you can imagine, shattering forecasts. Its investments in DoorDash and some other firms paid off. Julian Satherwaite reports.
Home delivery is helping to deliver the profits for Japanese investment giant SoftBank Group. Bets on firms like DoorDash saw the firm smash analyst forecasts. Third quarter net profit jumped more than 20 times to just over $11 billion. That is more than 6 times the figure predicted by analysts. The numbers will come as a relief to SoftBank chief Masayoshi Son. He was battered by a string of high-profile misses, such as the flopped IPO for office sharing firm WeWork. The problems forced him to sell assets and led some to ask if he'd lost his touch for investments. Now the gains follow a sea change at SoftBank's Mammoth Vision Fund investment unit. It alone booked a profit of $8 billion. The fund has been helped by a buoyant global equities market, which has driven tech stocks higher. That saw its 82 investments valued at about $90 billion, compared with a purchase price of just over $76 billion. The latest period also saw public listings for SoftBank-backed firms, including DoorDash and home selling platform OpenDoor.
And South Korean car makers Hyundai and Kia says they're not in talks with Apple on developing autonomous vehicles. It's a U-turn from an earlier media report. The news sent the car maker's shares tumbling today. Flora Bradley Watson reports.
South Korea's Hyundai said Monday it was not in talks with Apple about developing self-driving cars. The potential tie-up was first reported in local media last month, with Hyundai confirming the talks were at a preliminary stage. Its affiliate Kia was also reportedly involved in the discussions to develop electric cars and new battery technology by 2027. The initial report sent shares in both automakers soaring, but they tumbled on Monday after it was confirmed the talks had been paused. In separate regulatory filings, Hyundai and Kia both said, quote, "We are not having talks with Apple on developing autonomous vehicles." Apple typically insists on strict secrecy from its potential partners. The iPhone maker has never acknowledged it was in talks with Hyundai about building vehicles. In December, Reuters reported that Apple was moving ahead with self-driving car technology and aimed to produce a model of its own as early as 2024.
And China may be one step closer to making the yuan an international digital currency. It's teaming up with the biggest interbank messaging system, SWIFT, and it could be getting ready to globalize its own digital currency.
The world's largest electronic payment messaging system is teaming up with the Chinese regime's central bank. They're setting up a joint venture, and the move is raising concerns that China will use it to globalize its digital currency and challenge the dollar. The Society for Worldwide Interbank Financial Telecommunication, or SWIFT, is a system that connects over 10,000 banks and companies across the globe. The network, headquartered in Belgium, allows the banks to send and receive information about financial transactions. The U.S. had previously imposed sanctions through SWIFT, forcing it to cut ties with certain banks from Iran and North Korea. Since Beijing started to aggressively crack down on Hong Kong's freedom with the new national security law, concerns have been raised that the former Trump administration would cut off China or Hong Kong from the system as a punishment. That would be a nuclear option. To avoid the risk, Beijing has been trying to reduce its reliance on the dollar-dominated system and start its own game. And a major part of that is developing its digital currency. The new entity Beijing just established with SWIFT was registered last month. Its specific mission is unclear, but people who are working on China's digital currency will be involved. SWIFT is the largest shareholder, owning 55%. China has already rolled out pilot programs for its digital currency in several cities. Analysts say if China can be the first to develop a mature digital currency system, it can expand it to cross-border payments and therefore make its yuan an international currency.
Still to come. Are you willing to pay more for face masks that are fully sourced in America? One startup is betting on just that and is putting down millions of dollars to make it happen. Find out more after the break.
Why are millions of Americans moving their money into gold and silver? It's simple. The world has never been more unpredictable. The biggest economic crisis we've faced since 2008, and a government that's about to print trillions and trillions of dollars. That's why so many Americans are turning to gold and silver to protect their nest egg. American Hartford Gold is a trusted name to help families to safeguard their wealth. With an A+ rating from the BBB and 5-star ratings on the biggest review websites like Trustpilot and Google, American Hartford Gold can help you convert any qualifying IRA or 401k into precious metals. Or they'll help you to easily purchase physical gold and silver and deliver straight to your doorstep. Learn how you can protect your wealth with gold and silver today. Get this free 2021 information guide. Call 866-893-1493 or text TV to 65532.
A former New York stockbroker is investing $4 million to make face masks that are 100% domestically sourced. He hopes the pandemic will change the way Americans are willing to pay for high-quality masks Emma Gell reports.
With a brand new factory in a suburb of Los Angeles, Dan Izaki has bet over $4 million that the pandemic will change what Americans are willing to pay for high-quality face masks.
You know, we have the mission of reshoring the production of PPE to the United States, bringing it back for a lot of reasons.
Before COVID-19 hit, the United States imported much of the personal protection equipment needed by healthcare providers, mainly from Asia. Some U.S. companies pivoted in the crisis, such as liquor companies, churning out hand sanitizer, and plastics firms making face shields. But one item that remains in tight supply is N95 face masks, which provide a high level of filtration against airborne contaminants and are closely regulated by the U.S. government. Izaki, a former New York stockbroker, is president of United Safety Tech, a startup that is poised to open a new N95 mask factory in Laverne, California, possibly within weeks.
We use a completely domestically sourced supply chain, which means all the materials that go into this mask are truly made in America. That is critical to the biosecurity of our country.
The pricing of many types of protective equipment remains elevated by shortages. But once the market normalizes, Izaki estimates that his masks will cost about 30% more than Chinese masks, or about $1.15 each. He hopes that the pandemic will make Americans more willing to pay a premium, or that U.S. government policy will mandate more domestic sourcing, which would benefit his venture.
People will respect the Made in America label, and they will pay more. There's a bunch of things that need to happen in the supply chain to put us, to make us more competitive versus overseas markets, and I believe that's going to happen over time.
But there's always risk. Making masks isn't that hard. The process is highly automated and doesn't require a costly clean room. But getting a dependable supply of the materials, particularly the specialized layer of filtration material that makes them effective, is a challenge. Other domestic producers are likely to face the same challenges, including industry giant 3M, which has quadrupled its domestic production of N95 masks since the pandemic started and makes 100 million masks a month. But Izaki is ambitious.
This whole facility, which is about 45,000 square feet, will be full of equipment making respirators. As I mentioned earlier, we are planning to produce 1 million N95 respirators per day by the end of the second quarter of 2021. And you know what? I hope each one of them goes to a first-line responder that needs them.
Good idea. That's the latest business updates for today. You can still catch NTD Evening News at 6:30 p.m. Eastern. For NTD Business, that's all for today. Thank you for watching. We'll see you tomorrow.
Hi, we're happy to announce that you can also catch us on cable TV now. Millions of households already choose us as one of their trusted news sources, and you can too. You can watch us in Chicago, Washington, D.C., New York, and many other cities as well. And if your system doesn't carry NTD yet, you can just give them a quick call and request NTD on your cable provider. Thank you for watching. See you next time.